Something unprecedented is happening in the physical silver market. While paper prices collapsed to $73 per ounce, dealers across 3 continents began pulling inventory off their shelves. Not because demand disappeared, but because they cannot replace what they sell. Dubai spot prices hit $127. COMEX futures traded at $73. The same metal, 2 different worlds. And the gap is widening every single day. China controls 70% of global refined supply and just imposed export restrictions with no end date. The dealers who are selling out today know something the general market doesn't yet understand, and what they're doing right now is the exact opposite of what you'd expect during a crash. Welcome to Currency Talks. If you've spent decades watching markets, building businesses, or simply understand that real intelligence doesn't come from headlines, you're in the right place. We don't waste your time with hype. We bring you the strategic economic analysis that matters when capital is on the line. If that resonates with you, go ahead and subscribe. We'd also like to know, where in the world are you watching this from today? Drop your location in the comments below. Now, let's talk about what's really happening in the silver market. On January 13th, 2026, the silver market experienced something that defied basic economic logic. The spot price dropped 11% in a single trading session, and within 72 hours, bullion dealers from London to Singapore began displaying the same message on their websites. Out of stock. No estimated restock date available. This is not how commodity markets are supposed to work. When prices fall, inventory should become easier to acquire, not harder. When a crash happens, sellers should flood the market, not disappear from it. But that's not what happened this time. Let's examine the mechanics of what actually occurred, because understanding this sequence reveals something far more significant than a simple price correction. The crash began on the COMEX futures exchange in New York. Large institutional positions began liquidating simultaneously, driving paper silver prices down from $82 per ounce to $73 in less than 48 hours. Standard market commentary called it a technical breakdown, blamed recession fears, pointed to dollar strength. But here's what the surface analysis missed. While paper contracts were being sold in massive volume on the futures exchange, physical metal was moving in the opposite direction. Dealers reported their highest inquiry rates in 18 months. Mints began extending delivery timelines from 2 weeks to 8 weeks. Refineries stopped quoting spot prices entirely, moving to call for pricing models. This is the behavior of a market facing supply constraints, not a market experiencing a demand collapse. The contradiction becomes even sharper when you examine dealer premium structures. During the 2020 market sell-off, when silver dropped from $18 to $12, dealer premiums stayed relatively stable at $1 to $2 over spot. Inventory moved quickly. Replacement metal was available. The physical market simply followed the paper price down. This time, premiums moved in the opposite direction of spot prices. As COMEX futures fell to $73, retail premiums expanded to $9 over spot for standard products, and $12 for high-demand items like American Silver Eagles. Premium expansion during a price crash is a technical impossibility in a functioning market, unless the underlying supply dynamics have fundamentally changed, and they have. On January 9th, 4 days before the COMEX crash, China's Ministry of Commerce announced new export licensing requirements for refined silver. The official statement described it as a temporary administrative measure, routine regulatory updates, nothing concerning. The institutional reality was different. China produces approximately 70% of the world's refined silver, and overnight, that supply became subject to government approval processes with no clear timeline, no transparent criteria, and no guaranteed allocation. For dealers, this created an immediate mathematical problem. The silver they were selling today could not be replaced at anything close to current COMEX prices. Replacement cost from available non-Chinese sources was running $20 to $35 above spot. And even at those prices, allocation was limited and uncertain. So dealers faced a choice: continue selling at COMEX-based prices and deplete inventory they cannot replace, or pull back from the market entirely until pricing reflects actual replacement economics. Most chose the second option. This is why the phrase selling out after the dip is technically accurate, but strategically misleading. Dealers are not selling out because of overwhelming demand. They are selling out because they are choosing to stop selling. The COMEX margin requirement increases that follow the initial price drop accelerated this process. On January 15th, the exchange raised initial margin requirements by 42% for silver futures contracts. This forced leveraged long positions to either post additional capital or liquidate. Many chose liquidation, driving paper prices down another 6%. But each wave of paper liquidation widened the gap between futures prices and physical replacement costs. By January 20th, the disconnect had become undeniable. Small retail dealers in the United States were paying $89 per ounce to acquire inventory from secondary market sources. While COMEX futures were settling at $73, industrial buyers in Europe were being quoted $94 per ounce for guaranteed delivery. While COMEX futures were settling at $73, and in Dubai, where east-west arbitrage has historically kept prices aligned, physical silver was trading at $127 per ounce. While COMEX futures were settling at $73, the same metal, the same purity, the same weights, but two completely different pricing structures depending on whether you were buying paper contracts or actual physical metal. This is not a temporary dislocation. This is a structural fracture, and it's widening. There's a pattern that repeats throughout modern economic history. Governments announce policy changes using careful diplomatic language. Financial markets initially dismiss these changes as procedural, and then, months later, the full strategic weight becomes impossible to ignore. China's January 9th export licensing announcement followed this exact pattern. The official statement was bureaucratic, almost boring in its technical precision. New administrative protocols for refined silver exports, enhanced documentation requirements, routine regulatory alignment. Markets barely reacted. Silver prices moved less than 1% on the news day. But 3 institutional analysts in Hong Kong, 2 supply chain consultants in Singapore, and 1 senior trader in London all reached the same conclusion within 48 hours. This was not regulatory housekeeping. This was deliberate supply control, and the implications were severe. Here's why their analysis proved correct. China doesn't just produce 70% of the world's refined silver, it controls 70% because replacing that capacity is functionally impossible in any meaningful time frame. Silver refining requires specialized facilities, environmental permits that take years to secure, technical expertise that exists in limited concentrations, and capital investment that only makes economic sense at massive scale. You cannot simply shift this production to other countries the way you might redirect a shipping route. The infrastructure doesn't exist. When China placed refined silver under export licensing, it didn't create a temporary supply disruption. It created a permanent negotiating advantage over every industrial consumer, every monetary system, and every strategic reserve manager who depends on steady silver supply. And here's what makes this particularly significant right now. The timing wasn't random. China's announcement came exactly 11 days after the United States Treasury expanded tariff classifications on Chinese technology imports, 14 days after the European Union announced new semiconductor partnership agreements that excluded Chinese firms, and 23 days after Japan committed $2 billion to rare earth processing facilities designed to reduce Chinese supply dependence. Each of these moves represented attempts to reduce strategic material dependence on Chinese supply chains. China's response was direct. If Western economies want to reduce dependence on Chinese technology materials, they'll discover just how dependent they remain on Chinese refining capacity for monetary metals. This is corporate translation in its purest form. The public statement says, administrative efficiency improvements. The institutional reality says, we control supply, and we're reminding you of that fact. Now let's examine what happened to pricing when this reality began penetrating market awareness. On January 13th, 4 days after the export licensing announcement, COMEX paper silver crashed 11%. On that same day, physical silver in Dubai jumped 9%. These two prices are supposed to move together. Dubai has historically functioned as the equilibrium point between Eastern physical demand and Western paper pricing. When COMEX drops, Dubai drops. When Shanghai premiums rise, Dubai rises to capture arbitrage opportunity. But on January 13th, the correlation broke completely. While New York paper contracts sold off in panic liquidation, Dubai physical dealers couldn't source metal fast enough to meet inquiry volume. By January 18th, the spread had become absurd. COMEX settlement, $73 per ounce. Dubai spot ask, $127 per ounce. This is not a premium difference. This is two separate markets, pricing two fundamentally different things. COMEX is pricing the paper contract, the derivative, the financial instrument that settles in cash 98% of the time. Dubai is pricing actual metal, physical delivery, real allocation of scarce supply. And the gap tells you everything about which market reflects reality. European industrial consumers began paying attention first. Solar panel manufacturers require silver for photovoltaic cells. Electronics producers need it for conductive pathways. Medical device companies use it for antimicrobial applications. All of them depend on steady supply at predictable prices. When Chinese export licensing hit, their procurement teams didn't check COMEX futures. They called their physical suppliers and heard the same answer across the board. We can't guarantee allocation. Pricing is now call for quote only. Lead times have extended indefinitely. This is the language of genuine supply failure, not temporary market volatility. And it explains why bullion dealers began pulling inventory. They weren't reacting to falling COMEX prices. They were reacting to the mathematical impossibility of replacing inventory when 70% of global refining capacity just became politically controlled. The dealers selling out after the dip understand something critical. The dip is irrelevant. The supply structure just changed, and it's not changing back. There's a specific moment in every supply crisis when market participants stop pretending everything is normal. For silver dealers, that moment arrived during the third week of January 2026. Not because of headlines, not because of analyst reports, but because of phone calls that stopped getting returned. Let me explain what happened behind the scenes. A mid-sized bullion dealer in Texas operates with a standard business model. They maintain approximately 45 days of inventory based on average sales velocity. They replenish from a network of wholesale suppliers, mints, and refineries, and they price products at spot plus a markup that covers operating costs and generates reasonable margin. This model has worked for 17 years. On January 14th, it stopped working. The dealer's primary wholesale supplier, a firm they'd worked with for over a decade, sent an email at 4:30 in the morning. Effective immediately, all silver product allocations are suspended pending supply chain review. No estimated resumption date available. That same day, their secondary supplier raised minimums from $10,000 to $50,000 per order and extended lead times from 2 weeks to 90 days. Their third backup source simply stopped answering calls. This wasn't a Texas problem. Dealers in Florida, California, Ohio, and Arizona reported identical experiences within the same 72-hour window. In Europe, the pattern repeated with eerie precision. A precious metals dealer in Munich had standing orders with 3 separate Swiss refineries. All 3 suspended new orders simultaneously, citing raw material sourcing challenges. When the dealer pressed for details, one refinery contact spoke off the record. "We can't get feedstock. The material we're buying from secondary sources costs more than you're willing to pay retail. We're not running production at a loss." This is where the mathematical problem becomes impossible to ignore. Refineries operate on thin margins. They purchase raw silver, process it to specific purity standards, fabricate it into bars or rounds, and sell to distributors. If raw material costs exceed what distributors will pay, production stops. And right now, raw material costs are running $20 to $40 above COMEX spot, depending on volume and delivery timeline. So refineries have 3 options: produce at a loss and burn working capital, raise prices to levels that reflect actual input costs and lose distribution partners, or shut down production and wait for the market to correct. Most are choosing option 3. This created an immediate cascade effect through the dealer network. Without refinery production, dealers depend entirely on existing inventory and secondary market purchases. But secondary market pricing follows replacement cost economics, not COMEX futures. Private sellers know they cannot replace metal at current paper prices, so they either hold or demand premiums that reflect physical scarcity. By January 21st, the bid-ask spread on generic silver rounds had reached $18. Dealers were bidding $81 over the counter for customer sellbacks, while COMEX futures were settling at $73. They were paying $8 over spot just to acquire inventory they could theoretically purchase on paper exchanges for spot price. Why would they do this? Because paper silver doesn't satisfy customer orders. When someone walks into a dealer location or places an online order, they expect physical delivery. You cannot hand them a COMEX futures contract and call it fulfilled. So dealers pay whatever the physical market demands, or they stop selling entirely. The major online dealers move first. On January 22nd, APMEX, one of the largest precious metals retailers in North America, changed their entire website pricing structure. Instead of spot plus fixed premium, they moved to market price plus premium. That subtle wording change revealed everything. They were no longer pricing off COMEX spot. They were pricing off whatever it cost them to acquire physical inventory, which had completely disconnected from paper markets. SD Bullion followed within 24 hours. JM Bullion made similar changes by end of week. Smaller regional dealers simply stopped listing prices online, moving to call for quote models that let them adjust in real time based on actual supply costs. This is not how commodity markets behave during ordinary corrections. During the 2020 sell-off, dealers competed aggressively on price. Inventory moved freely, and premium stayed stable because replacement was straightforward. This time, dealers aren't competing, they're conserving. Every ounce sold today is an ounce they may not be able to replace for months at any price. And the dealers who understand this are making a calculated decision. Better to show out of stock and preserve capital than to sell inventory they'll have to replace at $50, $60, or $70 higher than today's paper price. The crash everyone is watching on COMEX futures is completely irrelevant to the crisis happening in physical markets. One is a price, the other is availability, and availability is disappearing faster than most realize. Every market crisis eventually forces a single question that separates informed capital from reactive capital. What is actually happening versus what appears to be happening? Right now, silver presents one of the starkest divergences between surface narrative and underlying reality in modern commodity markets. The surface narrative is straightforward. Technical breakdown, recession concerns, dollar strength, speculative liquidation, standard bear market mechanics that financial media can explain in 30-second segments. But let's examine what the data actually shows when you move past headline interpretation. The bear case relies on three primary arguments. First, that economic slowdown will reduce industrial silver demand. Second, that rising interest rates make non-yielding assets less attractive. Third, that the current price action represents legitimate price discovery based on fundamental supply-demand balance. Each of these arguments has surface validity, but each also ignores critical structural changes that have occurred in the past 30 days. Industrial demand for silver is not discretionary consumption that disappears during recessions. Solar panel production, electronics manufacturing, medical applications, these are not luxury purchases that vanish when GDP growth slows. They are embedded components of supply chains that have multi-year production commitments. A solar manufacturer cannot simply stop using silver because spot prices rose $20. They must source supply at whatever price the physical market demands, or shut down production entirely. The interest rate argument assumes investors treat silver purely as a financial asset competing with bonds and equities. But the current crisis is revealing something different. When physical supply becomes genuinely constrained, silver stops behaving like a financial asset and starts behaving like a strategic material. Strategic materials don't trade on yield curves. They trade on availability, control, and replacement cost. And right now, all three factors point towards scarcity, not abundance. The price discovery argument is perhaps the most misleading. COMEX futures are discovering the price at which leveraged paper positions liquidate under margin pressure. They are not discovering the price at which physical metal changes hands between willing buyers and willing sellers. That price, as we've seen in Dubai, in dealer wholesale markets, and in refinery input costs, is running $50 to $70 above COMEX settlements. So which price is real? The answer depends on what you're trying to accomplish. If you're a paper trader managing leveraged futures positions, COMEX pricing is your reality. If you're a business owner trying to secure physical inventory, a manufacturer requiring actual metal, or an investor who intends to take delivery, COMEX pricing is completely irrelevant. Your reality is replacement cost in physical markets, and that cost is not declining, despite what paper charts show. Now let's address what major institutions are doing while public attention focuses on COMEX volatility. Central banks in Asia continue accumulating precious metals at rates that exceed the past decade's average. Sovereign wealth funds are increasing allocations to physical commodities, not reducing them. Family offices with multi-generational time horizons are treating current price dislocations as acquisition opportunities, not exit signals. These entities have access to institutional intelligence that retail investors do not. They see refinery production data, customs export records, wholesale allocation trends, and they are acting in direct opposition to the bearish narrative being broadcast through financial media. This creates a decision framework for anyone managing capital with serious intent. For business owners, the question is whether working capital should remain in currency that loses purchasing power by design, or in tangible assets whose supply is genuinely constrained. For entrepreneurs building companies, the question is whether inflation hedging is theoretical risk management or practical survival necessity. For investors, the question is whether you're trading sentiment or positioning for supply-demand imbalances that resolve over quarters and years, not days and weeks. The historical precedents are clear. In 2008, physical gold premiums spiked to $40 over spot during the financial crisis, before spot prices caught up 6 months later. In 2020, silver premiums hit $12 over spot during the pandemic sell-off, before spot doubled within 8 months, both times. The physical market signaled reality before paper markets acknowledged it. The current premium structure, the dealer inventory drawdown, the refinery production halts, the Dubai price disconnect, these are not temporary technical anomalies. These are the early stages of a structural supply failure that paper markets have not yet priced. The dealers selling out after the dip are not panicking. They are reading supply conditions that most market participants are still ignoring. The gap between paper price and physical availability is not widening by accident. It is widening because one reflects financial speculation and the other reflects actual scarcity. The window to act on this information, while COMEX pricing still creates opportunity, is measured in weeks, not months.